I'm John Searcy. I'm the Senior AI Advisor for FinReg Lab. And it's a pleasure for me to introduce our two next speakers. I'm going to ask them to come up. Oren Cass is the founder and chief economist at American Compass. And Hans Morris is the managing partner at NICA Partners and the former president of Visa. And this session will be the Great Worker Debate. With that, I'll turn to you, Hans. Thank you.
Great. So thank you, John, and welcome, Oren. Thank you all. So how does all this affect the American worker? And both in general, how will AI affect the American worker? How will financial services respond? What can be done to make things better for that working class? And how should regulators approach that to make sure that policies are working effectively? And at least in my opinion, Oren is the most qualified person, the perfect person to discuss this. As John said, he's the founder and the chief economist of American Compass. And I think that he is, he's generally been associated with more conservative institutions and politicians, but I would say he's quite provocative and iconoclastic in all of his things that he's written. And I have read him for a while. I found that he's got fresh insights, he's got very strong arguments, and he has good data to support those arguments. And so I agree with him a lot, and I think you will too. He also, he grew up near Boston. He went to Williams College. He worked for Bain. He went to Harvard Law School. One line I like a lot, which is, if you don't want to be a lawyer, it's a lot of fun to go to Harvard Law School. He became policy director for the Romney campaign in 2008 when he was still in law school. And then at age 32, is hired by the Manhattan Institute, identified as one of the key thinkers even 25 years ago or 20 years ago. And then 2018, he published The Once and Future Worker, A Vision for the Renewal of the Work in America. That was a really excellent book. And if you haven't read it, I think everyone should read it. And many people, as diverse as David Brooks, Jason Furman. Jason Furman said, "A thoughtful, provocative, carefully argued book that maybe changed my mind on several issues I think I knew a lot about." And before we get started on the questions, he and I both, he lives full-time in the Berkshires, and he's chairman of the school board now in Lenox, Massachusetts. And I've had a house there for a long time, and I am a part owner of the Berkshire Eagle, the local newspaper. And Oren is on our advisory board, and just as strongly opinionated and interesting perspectives on that as what we're going to talk about today. People often ask, what nonprofits am I involved in? I would say the Berkshire Eagle, a local newspaper, is a nonprofit enterprise and has some analogies. We're going to talk about this a little bit in terms of local financial institutions and local media. Both serve important roles. Both have a great challenge given all the technology changes taking place in the United States. So we're going to ask these three questions. What is the future pathway to a decent life for those who do not go to college, and how will AI affect this? Second is, how can AI improve the delivery of financial services to this segment of the population, and what risks does that create? And third is, what can policymakers do to ensure better outcomes? So let's start. What's your general view on the effect of AI on the labor market and on the working class?
Sure. That's a broad question.
Yes.
Thank you for having me for that introduction. Very fun to work on the Berkshire Eagle with you. The issue I think that we have to focus on for workers, and as we think about technology, is that the quality of jobs ultimately comes down to the productivity of those jobs. How much can a worker produce with every hour of effort put in? And from that perspective, technology is typically over reasonable time frames and an almost unmitigated good. Technology is the thing that drives productivity growth, along with training and skill development. And it is the only way we actually raise prosperity, broadly speaking. I think what we have gotten so wrong in recent decades is to develop a conception of growth that disregards that. The metaphor that I think most of our political class became obsessed with, most of our economists, is the so-called economic pie, right? It was the idea that we could sort of conceive of of economy of GDP as a pie. We're going to grow the pie. Democrats and Republicans, we're all going to kind of discuss what's the best way to grow the pie, and then we'll have a debate on the back end somehow about how to slice the pie so everybody gets enough, but really only thought of individuals as consumers, and quite formally in our economic analysis, only worried about them as consumers. And so whether it was pitching a model of free trade that said, yes, it would leave some people behind, but the winners can compensate the losers as it goes, making a case for very high levels of immigration on the grounds that keeps costs down for consumers, even as it supports much less productive models for businesses and engagement in the labor market. And we're sort of like the rom-com protagonist who has everything she thought she wanted and yet realizes she's still not happy. We did it. Like, if you look at the economic data, in fact, we got an enormous amount of GDP growth. In fact, we do far more redistribution than we ever did. In fact, everybody at every socioeconomic level has more stuff if you're just measuring material living standards, and yet we look across what has gone on in the nation and recognize that somehow we also really failed. And I think it's because we just ignored that link. The productivity at the aggregate level in the economy surged, but the best evidence suggests that's almost entirely concentrated in productivity gains at the high end. Productivity for the typical worker, typical job, has essentially flatlined. One of the most shocking statistics, productivity in the manufacturing sector has been declining. For all the talk of automation, for all the initial claims about AI and so forth, you literally need more hours of work in an American factory to produce the same things you did a decade ago. And so it seems to me that we've just gotten everything wrong, both in how we support and prepare the typical worker who does not have a college degree to engage in the economy, and on the set of constraints and expectations and incentives we have for investors, for businesses, ultimately for a financial sector that decides where capital goes, that said we honestly couldn't care less what actually happens for the typical job, typical worker, just make more stuff.
Yeah. So what is AI? How will AI, will that just accelerate it if we don't make changes, or will that actually have different impacts? And what's your view on that?
Well, by default, it would potentially accelerate it. And I think the key thing is that any given technological change is pretty much agnostic. I know Larry spoke earlier about electricity. We're talking specifically steam, electricity. The Industrial Revolution is the quintessential example where initially it was actually awful for the working class. Primary reason for that, I think economic historians have focused on, is because it enabled child labor. All of a sudden, things that previously required physical strength no longer did. And in fact, children were the ideal workers in all sorts of roles. And that decimated the quality of life, labor market pressures, and so forth within the working class. It was only after people said, actually, we should prohibit child labor, that you actually started to see productivity gains for typical workers, rising wages, rising living standards. And it's important to keep in mind that at every stage, the comparable folks to today's modern economists said, don't do that. First of all, everybody has free choice, and if they're sending their children into the factory, that's because that's the right choice for them. And second of all, if you ban the child labor, you're going to raise costs, you're creating inefficiency, you're going to depress living standards. And we are essentially at a point now where we've been going through that again. And we don't have to make this an immigration and trade debate, but I would suggest the choices we have made around things like globalization, like immigration, have been a repeat of that exact same set of choices. And so as we move forward with AI, the question is, well, are we going to say we need the freest possible market to drive the most possible innovation, because that's going to create the most growth, and somehow we're going to wave our hands and claim that's going to be good for workers, even though we know it's not? Or are we going to recognize that what actually works best is if you do have constraints in place, not on the technology itself, but constraints on the business models, essentially, such that you get an alignment between that which is most attractive to invest in pursuit of profit, and that which actually supports productivity growth and better jobs for typical workers. And it's only if we're willing to hold those things in alignment that the technological change is actually going to be good for the nation as a whole.
And so you, to summarize this, so it's not that, are there specific policies you would point to that would be relevant to that objective, or is that something like saying that's the context, now we have to, it's going to be different how we apply it and all these different, healthcare workers or, teachers or lots of other examples of people, well, I guess teachers all have college degrees, but lots of areas of policing or things where there could be opportunities for dramatic growth in productivity, but where we have to be careful. Is that what you're saying, or what? Or is there something, a general rule you would want to apply?
So I think it's both. I think it starts wherever possible, and this is the conservative to me coming out. I would much rather have the broad rule of the road for everybody within which the market can just operate, instead of trying to go and fix specific problems in specific places. And so the most important broad rule we can have is just a very strong commitment to the idea that whatever you want to do with AI, you have to find a way to make it work with the workers you actually have here.
Right.
Because the first thing everybody's going to do as more and more of these advanced technologies roll out is they're going to complain that we don't have the right workers to use the technology.
Mm-hmm.
And where there's going to be a skills gap and a labor shortage. I love the term skills gap. I always say I have a huge skills gap because I have an idea for this super cutting edge biotech company. We're going to employ people at $9 an hour to develop just amazing breakthrough biotechnologies, and I can't find the workers anywhere. Mm-hmm. That's my skills gap.
Right.
Right? Skills gap is just a funny way of saying bad business model.
Mm-hmm.
And so, sorry. And so this is what you're going to have happen. And then people are going to say, well, so obviously, what would be really efficient is if we can pair all of this new technology with all of these, highly trained technical workers in India who can manage our technology from there for $4 an hour. It's just incredible. What could go wrong? And the answer is to say, actually, no, we are not interested in that because I understand what that does for GDP growth, but it does absolutely nothing for workers. And so one of the key ways in which historically I think technological change has worked out very well for workers is because you could only roll it out as quickly as you could make it work with the workers you have.
Right.
That's actually the constraint. And so that mindset of we're not interested in arguments that we don't have the workers for the technology. If you want to make money, you're going to have to find the technology for the workers is the key. And if you get that right, and that's a trade question, that's an immigration question, that's a services regulation question, frankly, I think you get 90+% of the way there.
Right. So we may want to come back to this because I think there's some good examples of, and I personally believe, at least right now, and certainly in financial services, I can say this with a lot of confidence, that most of the AI is going to have humans in the loop, actually, because it all comes down to data, and human reinforcement of decisions and conclusions is going to be around, I think, for a while, and I think that could be true in many, many other applications where there are lower, where working class people involved. There has to be open-mindedness, though, I think, in getting there. That's a key question, which we also could come back to. But I do want to talk a little bit more about the financial sector in particular, and you've written a lot about, if I was to call it, the unexpected consequences of the way the United States capital allocation process works, and maybe you can describe a little bit how the macro view you've had of that, and then we can talk about that in AI.
Yeah, I mean, the fundamental problem that we have is that we don't use the word investment correctly, right? A private equity firm goes and buys a company, and we call that investment. And it's not. No investment has actually occurred. We have exchanged one pile of assets, cash. It's actually levered, debt-fueled cash. But let's just call it cash for this other pile of equity. And we've just exchanged those two piles. Nothing has actually happened in the real world. No investment in building anything that creates productive capacity has occurred. And what we see in the financial sector over the past 30 or 40 years is that the sector as a share of the economy keeps getting bigger. It keeps absorbing more of our top talent. It is responsible for more of our profits, higher levels of compensation. Actual investment in the economy as a share of GDP keeps going down. What we are doing is not using capital markets to more effectively pool savings and deploy it productively. We are using it to construct new financial products, convert operating entities into financial assets, and then trade them around in circles. And lots of people can make a lot of money doing that. But not only is it not good for the economy, at the margin what it does is it creates exactly the wrong incentives. Going back to that idea of how do we align the things that are going to be most profitable with the things that are also good for the nation, if the most profitable thing to do on Wall Street is raise a fund and take that and go and deploy it toward building a new business somewhere, I feel very good about where things are. The most profitable thing to do on Wall Street is start a hedge fund and pay more for rent, you know, 1 block closer to the stock exchange so your Ethernet cable is shorter and your high frequency trade goes through faster. I'm quite certain you're in fact just wasting talent that otherwise would be used more productively. And so I think what you see both at the most macro level, the financial sector going way off the rails, and then in terms of the types of investments you see, they are overwhelmingly focused on, you know, certainly asset light investments, things that, you know, unicorns that can get to $1 billion very quickly. Even within the venture capital sector, a real focus on, okay, what has the potential to essentially achieve a monopoly somewhere? That's kind of the goal, and we're gonna, you know, chase the 1 in 1,000 that gets that, and that you can generate a lot of value in the stock market that way. What you don't actually do is create good jobs. You don't create rising productivity. And frankly, at this point, I would say you don't even create very much innovation.
Yeah. So let's talk about this a little bit. So we invest in fintech venture firms, and in many cases we are seeking models that help people, and you know, either help people manage their debt more effectively, or you'll meet Jimmy Chen later, who has a company that serves you know, almost 6 million people who are on food stamps and helps them navigate a complex world. And so there's things, we have a standard that we use, which we says, look, modern financial services, if you apply what you expect from Netflix or Apple, a lot of other top tier companies, we'd say every transaction should meet 4 criteria, which is it's relevant to you, it's fair to you, it's seamless for you to execute, it takes 2 or 3 clicks, it's very simple, you don't have to try, and it's easy to figure out, and it's safe and secure. So those are 4 key criteria, and I think if you honestly assess how many transactions that you engage in financial services meet all 4 of those criteria, we have a long way to go in all of this to get to that, and particularly for poor people, I think, in this segment you're talking about. It's hard, in many cases, to get to the right answer, to trust providers, to not get ripped off, to know who's safe, that it's properly priced for the risk that you're taking, which could be risky, but it's fair, given that risk. So there's lots of examples I can think of, at least, where AI could make it easier to be more relevant, could make it certainly more seamless to execute, figure things out for you and for the provider. It's definitely a double-edged sword. Fraud, it's making it worse. Scams are worse, but you could also see how AI does and can reduce false positives, take friction away from people who, you know, it's a good transaction, don't worry, and help make that more clear. It can reduce delivery costs. And I think it could also help that working class make better decisions, like do this, not that, because behavior often is counteracting, you know, what is really a good rational decision. So what do you think about that? Is that true? What are there guidelines you'd like to see, or and you've written about, and we were just talking about the local providers of services versus global or national providers of services. What observations would you have about what you would want to try and shape it in a better way rather than a worse way?
Well, I should say I have wisely discovered, I will say it is wisely, never debate with individuals in the financial sector about their own set of investments.
Right.
Because every investor recognizes a huge problem out there of which they are not a part.
Yeah.
And I stipulate that that is the case with your
investments. No, we make plenty of really stupid decisions, let me assure you, and we create more problems in many cases too.
In terms of sort of the quality and value of what those firms are doing, it's, you know, you even within the hedge fund sector, you get some big hedge fund GR department will call me up and say, gotta say, this research you just published on like the train wreck that is the hedge fund sector, like that makes a lot of really good points, but I want you to understand that's not what we're doing.
Right.
I say, I'm sure that's true. If I step back and look at where I see innovation in financial services for lower income households today, where the capital seems to be flowing, where the profit pools are, number one is sports betting. That is an absolute cancer on our society at this point and a catastrophe for lower income households. It is, the amount of good research on how bad this is and how quickly it has come out is shocking. I don't know if we've ever seen that fast a turn. And the deployment of ever more technology to make it ever more fun and easy and attractive to bet money on your phone is the sort of financial sector innovation that I actually see us pursuing by default, and that I actually suspect people are going to be most eager to use AI to make more efficient and deliver more shareholder value through.
I agree with you, by the way.
Number two would be Klarna, right? I remember there was some point when I was like, you're actually like buying a $1,000 airline ticket and you could like make it in 4 payments. I thought, oh, that was interesting. And now like you check out for your cup of coffee and you can make it in 4 payments. I don't think there's any plausible case to be made that that is a useful financial product, or one that is ultimately actually good for the people it claims to be serving. But again, I bet you can make an awful lot more money doing that than you can helping people use their EBT cards and navigate the food stamp program more effectively. And so my concern about the financial services sector is not that there isn't an enormous amount of upside where AI could be deployed to really make things better for working class families. It's that that's not where the profit pools are. And that the basic model that we have had that says, well, if you have less financial if you have less in any sector, but certainly in the financial sector, less regulation, that creates more space for innovation and efficiency. And I mean, we could all hit the notes of the story, and yet. Again, all of that assumes, first of all, that the consumers here are sort of highly rational, effective actors in their own right, and that at the end of the day, what we're optimizing for is simply the volume of transactions and economic activity. And if you release those 2 assumptions, then the case for a deregulated financial sector vanishes. And so, I said kind of from the worker perspective, I think there's a tremendous amount you can do just if you maintain that tight labor market and hold that alignment. From the perspective of the working class and less educated lower income households as consumers of financial services, I'm extremely skeptical that our market profit driven system is or will be serving them well absent very high levels of regulation that say, no, actually, we do not trust the private sector at this point for frankly very good reason.
Yeah, well, actually, just to be clear where I'm coming from this, because I often say this, which is everything is regulated in financial services for a good reason, because there's lots of abuse. We have systemic risk concerns. We have institutions can sometimes operate in a very safe and unsound way. You can have bias, which is something we care a lot about, obviously, and trying to address that. And so there's, I completely agree, there should be regulation. And also people make bad choices, the point that we were making before on all kinds of things.
I have to say one of my favorite developments of the past year was the Silicon Valley Bank collapse.
Yeah.
Because it was really wonderful to see that hey, look, even extremely sophisticated financial actors with hundreds of millions of dollars just put them in an uninsured savings account.
Yeah.
And so I just, never again do I want to hear anyone tell me about, how we should have a financial system based on all of these, hyper-efficient, rational actors, when even the most sophisticated possible actors in the system were wildly ineffective, at best clueless, in how they were conducting themselves.
I think if we went back, Larry said this, if you go back in many examples in history and just in my personal experience, saying these guys are really smart, don't worry, is a classic mistake. And
they're often the ones you need to worry
yes,
most about.
Long-term capital, that was Enron, they're the smartest guys in the room. And actually, I would, if you've never read it, the book on the article that Joe Nocera wrote about VAR, value at risk. I thought that was one of the best examples of what brought on the financial crisis. And everyone's saying VAR, and VAR is a model, and the models, explain away things, but also have a lot of assumptions that you need to think about.
Well, and by the way, I think there's a lesson there for what we envision AI doing within financial institutions. That, in a sense, the selling point is that it's like extra smart.
Yeah.
And it is extra smart in the least flexible, least humanly sensitive ways.
Mm-hmm.
So in effect, it is like the most perfectly designed tool to do as badly as possible the things that the financial sector has gotten most wrong in the biggest crises. And I think we should probably bear that in mind as we deploy it.
So let's zero in, though, in our last 6 minutes here, because I think, you care about this working class group, so the bottom 25%, the people who, and I think you point out in your books that we spend a lot of money and a lot of efforts at the policy level that don't work very well, and so we want to try and have several people in this room who are influential in setting policy. What do we want them to leave with, saying, in approaching AI in financial services, let's say, here's some things you'd like to see, and we could, you could riff on that. I could give you a couple hints, or you could. But why don't you start, and then I'll massage that a bit.
Well, I want to offer one slightly different, or one adjustment to the question, which is, I think it's important not to think of the working class as the bottom 25%, right? We still have roughly 25% of the population that doesn't complete high school.
Right.
Or if they do, they are not earning a diploma attached to any meaningful academic accomplishment. The working class is really the
next 25%.
Is the 20% up to really the 60 or 70%. And that is essentially everybody who does complete high school but either doesn't earn a college degree or earns one that, again, itself, the value is difficult to tell. I mean, close to half of people who earn a college degree still end up in a job that doesn't require a degree. We have a mismatch there. And so,
so that group, just to press it, so that's not the credit invisibles. That's these are people who are educated. They probably have a bank account. They probably, actually, I would say, if you top 60% of households, they're pretty well served in basic financial services. I would say, and I think the data would support that.
They're basic. They're connected to basic financial services.
Yeah.
How well they're served by them would be a slightly different question.
Mm-hmm.
But the one other thing just to say about them is, something that we've started doing a lot of research on at American Compass is what we call job quality. Well, everyone calls it job quality. What we call it is a secure versus insecure jobs, because we, of course, do an enormous amount of work to track employment every month to the decimal point. We have the information, but for some reason choose not to look at all about the nature of those jobs when we report it. And you can even do very basic survey data that makes you see that with a very basic threshold for what I would call a secure job, $40,000 a year, health benefits and paid time off, predictability in scheduling and future earnings. Those are your only requirements. Only 40% of the jobs in the country meet that criteria today. For people without a college degree, it's about 30% of jobs. So you're talking about 70 to 100 million jobs, virtually everybody in that group that we're talking about that sort of has that, the type of job that for people in this room you would sort of think of as that like bottom 25% job. It's not. That's where most Americans are. And so when we think about what it means for financial services to serve those people effectively, what role new technology can play in that, I think there are two things to say. One is, again, a lot of it comes back to the labor market side of it. How is our economy actually starting to generate better jobs for them? Because what they need for financial security is the predictability of a stable paycheck that is high enough to support a family. Mm-hmm. And then in terms of how financial services then support those folks, I think a lot of it comes down to actually needing a level of support at the community level that sees in the mission of the provider more than simply maximizing shareholder value. Mm-hmm. Because it is going to be very difficult to find a world where actually serving those people well, not just extracting cash from them, is the best way to make money in today's financial markets. Mm-hmm. And so, whatever we can do to support and push financial services activity back down to the community level where those factors are more likely to be in consideration, where people are actually more accountable to those around them, not to how they treat somebody 2,000 miles away, I think the better financial services will ultimately serve those folks.
So would you say, for example, we have in the United States pretty much a unique organization of financial services. We have more banks per capita than any other country, many of which, though, are facing a difficult, they look at AI and say, we need it because we need to compete against the big four and all the non-banks, and but there's, you don't have the talent necessarily, but the vendors, I think, will probably emerge, which help them, but that's a hard group to reach, and they sometimes feel that the regulators don't enable them to experiment. Do you have any thoughts about that? How do we so you want community banks to thrive.
Yes.
But they need infrastructure to participate in this world that's inevitable. What do you think?
They do, and so there needs to be some combination of supporting them in deploying that infrastructure, and eyeing with a lot more skepticism the flip side of it, which is the big four. I mean, I think, antitrust, and I don't mean this from the perspective of like Sherman Act enforcement, but conceptually recognizing that financial services is among the increasing number of sectors of the economy where economies of scale don't really have a logical endpoint. And again, going back to like how capitalism is actually supposed to work, you're supposed to have that upward pointing supply curve. It's supposed to get more expensive to keep doing more of it, which is one of the checks on excessive consolidation and so forth. Financial services does not have that, at least the way we regulate it today. And I don't think that serves either the economy writ large or folks who are not the profit pool for the massive conglomerates very well. And so deconsolidating the sector, I think, again, isn't going to look efficient, just as regulating child labor probably didn't look efficient. But I think will actually be better both for people and ultimately for the economy.
Since this is not a theoretical question, since you do talk to a lot of the key people in the new administration and people in Congress who have influence, what piece of advice, what would you like to see in the first 100 days addressing this? What policy would be important to you on this specific topic?
Well, I think ultimately it's a question of appointees and what trade-offs they make and what priorities they do and don't have. And so what I would like to see is a set of appointees who are not entirely of Wall Street and who do not see their task as making it as easy as possible to make a lot of money on Wall Street, which is the typical historical profile of a certainly Republican administration, to a significant extent Democratic administration, appointee for regulators of the financial sector. And then I think it's actually really important to have some initial actions that are, in a sense, high-profile shots across the bow. Like my favorite one is just banning stock buybacks, which of course was the law until 1983 when we said like, no, that's not insider trading. Why shouldn't companies be allowed to trade on inside information in their own stock? Not sure why they did, but you can say like, well, what does that have to do with this stuff we're talking about? And what it has to do with is beginning the process of reversing this 30 years of just believing that more and more, quote, efficient capital markets are actually going to lead to productive deployment of capital and serving the typical community when in fact they have not done that at all.
All right. Well, thank you for that, finally, for that very iconoclastic Republican commentary. So thank you for that. We'll move on to the next topics. Thank you.
This was great. Thank you very much.